A little over a week ago, Indian billionaire Gautam Adani was the world's third richest man. He ended this week well outside the top 10 in what's amounted to perhaps the fastest loss of wealth in history. Adani's companies had more than 100 billion US dollars wiped from their value. His share of that, more than 50 billion US. But there are fears that the fall won't end there, triggering a contagion that could hurt the Indian and the global economy. Gautam Adani started with virtually nothing. His father was a textile merchant from Gujarat. He's one of 7 children and was a university dropout. But through the force of his personality and exquisite connections, Adani and his brother Vinod, the 6th richest person in India, became amongst the wealthiest people on the planet. But it hasn't been easy. Gautam Adani survived a kidnapping in 1998. He was released after a ransom was paid. He was at the Taj Hotel when the Mumbai terror attacks took place, but was rescued. His wealth catapulted during the government of Narendra Modi. Modi even used Adani aircraft in the past during an election campaign. But in the past 5 years, Adani's wealth has soared by more than 20 times. By early this year, he was wealthier than Bill Gates, than Warren Buffett. He even passed Amazon's Jeff Bezos. But the question that threatens Gautam Adani's future is the one posed by short-selling investor Hindenburg Research. It asked, is it all a con? Hindenburg Research famously took down US electric truck manufacturer Nikola. It accused it of faking a video showing its vehicle working when it was simply rolling down a hill. Following that report, Nikola Chief Executive Trevor Milton was found guilty of 3 fraud charges.
Today, we announced charges against Trevor Milton, former CEO and Executive Chair of Nikola Corporation.
With Adani, Hindenburg's 2-year investigation includes that the mining conglomerate engaged in stock manipulation, accounting fraud and money laundering, the biggest con in corporate history, it's said. The reaction on India's stock market was instant. In just over 6 hours of trading, the Adani group of companies lost more than $70 billion in market value. Adani, though, was quick to rebut the claims. In a 413-page response, the company said the short seller's actions were nothing short of a calculated securities fraud under applicable law. Here's Adani's CFO, Jugashinder Singh.
Our informed and knowledgeable investors are not influenced by one-sided, motivated and unsubstantiated reports with vested interests.
The timing of the attack from Hindenburg was deliberate. It targeted a new $2.5 billion US share sale. That sale was pitched with a floor price of 3,112 rupees per share. But after the Hindenburg report, the share price crashed well below that. Nobody in their right mind would buy the shares when they could buy them cheaper on the market. Adani had no choice but to pull the pin on the buyback, and that sent the shares tumbling even further to around 1,500 rupee. By late this week, Adani Enterprises had bombed out to a market cap of 21 billion US dollars. It was down 54%. Across the 9 Adani companies, including ports, green energy, power and transmission, the combined loss was 108 billion US dollars. Even worse, its corporate bonds were sold off to distress levels. The rates on those bonds soared, and there are key bonds due to be rolled over in the coming weeks. Another test for the company's resolve and solvency. As Gautam Adani pulled the share sale, he spoke for the first time.
Despite the volatility in the stock over the last week, your faith and belief in the company, its business, and its management has been extremely reassuring and humbling for all of us. We are very confident that we will continue to get support in the future also. Thank you again for your trust in us.
Now regulators and governments are having to assess the impact of a potential collapse of the Adani empire. Indian banks have exposure to around 40% of Adani's total group debt. Analysts claim this is manageable. India's Reserve Bank is doing its own investigation, asking its banks to release their exposure to the Adani companies. Citigroup's wealth unit, meanwhile, put a stop on margin loans on Adani securities. And while Gautam Adani works to stem the flow from the losses from his share prices, you need to also consider the millions, perhaps hundreds of millions of dollars that Hindenburg will have made from the release of its report just a week ago. Adani says it's exploring legal action. The question is whether it has enough time to see it through the courts. Now, one of the reasons that Adani's wealth soared so rapidly is his exposure to energy, including the Carmichael coal mine in central Queensland. The controversial mine is now in production and has benefited from a 900% jump in energy coal prices to September last year. Now, prices since then have fallen from $450 a tonne to under $250 a tonne today. Joining me, David Lennox, resources analyst with Fat Profits. David, many thanks for your time. Just explain the move in coal prices, what really triggered that, because it really was all about the rise in the wealth of Adani, not just in coal, but in other forms of energy as well.
Oh, look, there's no doubt about it, yes. The Carmichael mine, it came along right at the right time for Adani. You had the Ukraine-Russian war start, you had the COVID reopening of the world, which was putting additional pressure on the demand for electricity, and very rapidly as well. So what we saw was a power generation sector that was hungry for coal because they had this huge surge in demand for electricity, but there was just no coal available because there had been that lockdown. We'd seen the industry basically go very quiet for over 12 months, no investment. And when that surge came, that surge in demand brought a surge with coal. And of course, no coal available. We saw those prices literally just go through the moon, and that's what happened. That brought all coal producers into significant cash flow and profit. So anyone who owned a coal mine were really swimming in cash.
Which was really seen over the course of the past 12 months. That the very best performing shares on our stock market were all coal miners. It didn't matter whether it was Centennial Coal or Yancoal or any of these types of things. So it just shows the wealth effect of it when prices went from $50 to $450 a tonne.
Oh yes, it certainly did, because what you've seen happen is that the base cost of producing a tonne of coal over that time period hadn't changed very much. What we did see then was the huge leverage of margins you got when there was a significant uplift in the coal price. So with a very low base cost that we have a lot of our producers here are, with that very low cost base, they were going to enjoy huge margins. All they had to do was get those volumes up, big margins, and what do you reckon you're going to see at the end of the day?
Yeah.
A lot of cash, and that's what we saw.
OK, there's a lot of other factors at play here, but that also was part of the reason why electricity prices spiked in Australia last year. It wasn't just the story of the gas. It was partly that, but it was also a story that there was a shortage of coal because many of these coal miners had shipments and contracts to send that coal overseas. There wasn't a lot of cheap coal left here in Australia.
There was no cheap coal left. Primarily, if you were digging it out of the ground, you wanted to send it overseas because that's where you were getting the maximum price accretion from. Not a lot of electricity here in Australia is actually generated through gas terminals. Yes, there are a few, but really we still are reliant on those old-fashioned coal-fired power stations, and really they needed the coal as well, because Australia was going through the same surge in demand for electricity after the shutdown. Not quite as much as perhaps in some other countries, but there was still that huge demand for electricity. And of course, the poor old coal companies here, the poor old power companies here had to go and find the coal wherever they could, or they paid up for it. They had to pay up for it, and they're not going to wear the price losses. They pass it on to their customers, and that's what happened. There's
another little bit of history that's sometimes forgotten here, and that was the floods played a significant impact on the price of coal because of Australia being such a significant producer of coal. That the floods meant that some of the mines were flooded, some of the power stations couldn't get the coal they required. They had to go and find it elsewhere. So all of this sort of almost a perfect storm for the coal market, and therefore even for that Carmichael coal mine last year.
Yes, look, it certainly was. You'd have to say that the rain came at a bad time when there was a surge in demand already, and power stations just couldn't keep up with it globally. Not a lot of the mines actually got flooded out to a point where they impacted significantly on production, but certainly there were some problems, mainly with getting from where the mine was to where the coal was needed was more the problem. But once we saw that logistics chain being repaired, it was repaired quite quickly in most cases because it happens time and time again, maybe a little more frequently now. But certainly once that logistics chain was fixed, then we saw that those operations get very quickly back to normal.
OK, so one surprise out of the federal budget when it was handed down by Jim Chalmers in October last year was the forecast of a massive drop in the price of coal. And everybody went, hang on, the price at the time was just off $450 US a tonne. But it is fair to say that there has been really a very sharp sell-off in that price of coal since then, now sitting under $250 US a tonne for thermal coal, the stuff that generates the electricity.
Yeah, look, that's certainly the case. And you think about it, that is what we're going to see happen. What happens when we see a huge uplift in prices? Everybody finds and digs up coal. And that's what we saw happening. The logistics change through the reopening of the world started to normalise. The Ukraine war, as it's gone on and on and on and almost become part of life, unfortunately, the logistics chain around that became normalised. So once that normalises, the prices have only got one way to go. Oh, we can now get coal, they go down. But you've got to remember, they're still significantly off where they were prior to COVID,
yes,
and prior to the start of the Ukraine
Well, remember, people said there would be no more coal mines, there would be no more coal. It wouldn't, the whole industry was going to die. They wouldn't be able to get finance. But the reality is that the world needed the electricity, the world needed the coal. So even in Germany, they were looking to reopen coal-fired power stations. In China, which clearly had a ban on Australian coal, suddenly realised its shortfall meant it turned over that decision and started to take back Australian coal. So all of these things were driven by necessity for power and relatively cheap power.
Yep, they sure were. Without that demand for power, that surge for power, we wouldn't have seen any of this. But of course, it's come along, and coal companies are taking advantage of it. And why not? Because they may not have a long life history. In 30 or 40 years' time, there may not be too many coal-fired power stations around, and there will be probably fewer coal mines. So what do? You make hay when the hay's there to be made. So that's what we're seeing happening. And we're seeing companies like Whitehaven, who was not that long ago a basket case in terms of companies. Now it's a darling.
Yeah.
It's swimming in cash. So how quickly a change in the underlying commodity can change the fortunes of...
Which is why that Carmichael mine is so politically sensitive but economically sensitive, because it has been developed. It is shipping coal now on the railway. So the whole point about this was it may have been scaled back from where they originally intended it, but it's producing the coal. That's one of the things, because getting a new coal mine out there is a tough thing these days.
It sure is. And the fact that it's producing coal, it's producing it at a pretty good cost, even though it has had its tail chopped off a bit, is still making significant money, even at the level where the coal price is at the moment. So you'd be pretty happy if you were Adani. Yes, you'd be even happier at $400, but why complain when you're still making very good margins?
Now, I guess the interesting question is going to be the need for capital in the future as they try and expand that mine, and just Adani's situation at that time is going to come into question as well. David Lennox, always great to chat to you from Fat Profits.
Thanks, Ross.
Many thanks for your time today.